The IRS has a rule most retirees don't find out about until it's too late. And when they find out, they're usually staring at a tax bill they never saw coming. It's called the required minimum distribution. And if you have a 401k, a traditional IRA, or most any tax-deferred retirement account, this rule applies to you. And here's the scary part. If you miss it, the IRS doesn't just charge you taxes. They charge you a 25% penalty on the money you should have taken out, money you didn't even touch. Today, I'm going to show you exactly what RMDs are, when you have to start taking them, how to calculate them, and then most importantly, how to build a plan around them so you don't get blindsided. Also, stay till the end because I've got something that could save you thousands of dollars in taxes in retirement. Welcome back. If you're new here, I'm Eric, president of Shrum Private Wealth Management and a CFP professional. This channel, it's about taking off the stuffy suit and tie and helping you make smarter decisions with your money, especially as you approach or enter retirement. Real retirement planning for real people. Hit subscribe if that sounds like you, and let's get into it. For most of your working life, you've been stashing money into tax-deferred accounts. Your 401k, your traditional IRA, your SEP-IRA, maybe a 403b. And these are incredible tools because you get to skip paying taxes on that money now and let it grow and compound for decades. But here's the thing. The IRS has always known that that tax bill was coming due. And they weren't going to let you just defer taxes forever, unfortunately. So they wrote a rule that says once you hit a certain age, you must start pulling money out of those accounts every single year, whether you need the income or not. And that mandatory withdrawal, that is your required minimum distribution or your RMD. And the reason RMDs can sting is rather simple. Every dollar you pull out is taxed as ordinary income, just like you were getting income from your job. So if you're in a decent tax bracket, suddenly withdrawing 30, 60,000, maybe 100,000 or more from your IRA, whether you like it or not, that can push you into higher marginal tax brackets, even trigger higher Medicare premiums, and make more of your Social Security taxable. And the ripple effects are real. This is why understanding RMDs isn't just some administrative checkbox. It's a core piece of your retirement income strategy. All right, so we have a big question now, and that is what age do you have to start taking these RMDs? And this is where people get confused because, well, it's the government and they make things confusing, but I'm going to make it simple here. And the rules have changed over the past few years, so pay attention here. For years, the RMD age required minimum distribution was 70 and a half. And yes, that half birthday actually mattered, which was, again, needlessly confusing. Then Congress passed the Secure Act in 2019 and moved that age from 70 and a half to age 72. Then they passed the Secure Act 2.0 and that age changed again. So I'm going to outline very clearly what the ages are now, and you can find where you fall. So here's where it stands today. If you were born before 1951, you're taking RMDs. So if you haven't taken an RMD, get on that and get a CPA too. If you were born between 1951 and 1959, your RMD age is age 73. If you were born in 1960 or later, your RMD age is 75. So depending on when you were born, you've got more or less runway to really plan and strategize around your required minimum distributions. Now, and this is important, you actually don't have to take your very first RMD by December 31st of the year you turn that required age. You actually get a one-time grace period to delay until April 1st of the year following the age that you turn 73 or whatever age your RMD age is. But there's a trap that a lot of people fall into. If you delay that first RMD till April 1st, you still have to take your second RMD by December 31st of that same year. So you could potentially end up taking 2 distributions in 1 calendar year, which can mean a nasty, unnecessary one-time tax spike. In most cases, it actually makes more sense to just take your first RMD in the year you're required to and avoid that double hit. But that's a conversation worth having with the professional because everyone's situation is different. Okay, next, let's talk about how RMDs are actually calculated. And honestly, I think you as a taxpayer and an individual, you only need to understand this up to a point if you're working with a financial professional, financial advisor, because really they should be calculating this for you. So I'm going to give you just a high overview so that you're empowered with this knowledge. So let's answer that question. How much do you actually have to take out? The IRS, it doesn't just pick a random number to say, hey, take this out of your retirement accounts each year. They use a formula. And that formula is your RMD is equal to your account balance divided by what the IRS calls a life expectancy factor. And your account balance is whatever your retirement account was worth on December 31st of the prior year. Your life expectancy factor comes from an IRS table. And most people use what's called the Uniform Lifetime Table. And the IRS updates this periodically. And that factor goes down each year as you get older. And what that means is the percentage you must withdraw actually goes up each year for your RMDs. And so you can find that your RMD increases meaningfully as you get older, which is a problem, a tax problem for a lot of people. Now, you can always take more than your required minimum distribution. You just can't take less without triggering that 25% penalty on the shortfall, okay? And if you have multiple IRAs, you calculate each one separately, but you aggregate and take the total from any one or combination of your IRA accounts. So you could take your required minimum distribution from just one IRA account, even if you have 4, as long as you satisfy the required minimum distributions from the whole of your retirement accounts. Now, 401ks are a little bit different and they have to be satisfied separately from each plan. Again, I'd like to tell people not to get too hung up on the details of this rule if you are working with a good financial planner, financial advisor, because they really should be taking that upon themselves to calculate your required minimum distributions on the accounts that they know about and giving that amount to you and even helping you process that withdrawal. Now let's talk about which accounts that you have are actually affected by RMDs and that the IRS is going to require you to take money out when you hit your RMD age. And this is really important. So listen up here because not all retirement accounts actually do require RMDs. So let's hit just a quick list. Which ones do require RMDs? We've got traditional IRAs, SEP-IRAs, simple IRAs, 401k plans from your employer, 403b plans, 457 plans, and most inherited retirement accounts. Retirement accounts that do not require RMDs, and this is important to pay attention here. Roth IRAs do not require RMDs. And this is a massive advantage of Roth accounts. As long as you own it, you never have to take money out if you don't want to. This can be exceptionally powerful if you ever want your heirs to inherit a Roth IRA eventually. Roth 401ks, they used to require RMDs, but since the Secure Act 2.0, they eliminated that rule. So Roth 401ks, any kind of Roth account is not going to require a required minimum distribution. And this is where we'll touch on this in the next section, but strategies like Roth conversions you may have heard of can be very powerful, which is essentially paying taxes today in order to move it to a Roth IRA so that you don't have to pay taxes in the future. But again, we'll talk about that here in the next section. Okay, now in this section here, guys, I want to talk to you about smart strategies around required minimum distributions. In fact, we're going to talk about 3. Although there are more, these are 3 very powerful strategies that you can look into for RMDs. And really, this is what separates people who handle retirement well from people who get caught off guard. It's not just knowing the rules, it's having a plan built around those rules. And there's several strategies worth knowing about, but let's hit 3 here. Number 1, qualified charitable distributions, or what's known as QCDs. If you are charitably inclined, this is one of the most underused tools in retirement planning. Now, once you turn age 70 and a half, so not age 73 or 75 like your RMD, but actually earlier at age 70 and a half, you can donate up to $111,000 per person per year directly from your IRA to a qualified charity. And that donation counts towards your RMD. And it's actually excluded from your taxable income entirely. You don't deduct it. It just never shows up as income. For charitably inclined retirees, I cannot tell you how much of a game changer this can be for lowering your overall lifetime tax burden. Next, we have strategic Roth conversions. And this one is a big buzzword, and for good reason. Because in the years between retirement and then when those RMDs kick in, many retirees find themselves in a temporarily lower tax bracket. You might find yourself in that situation right now. And this is often the ideal window to convert chunks of traditional IRA money into a Roth. So essentially, you're filling up your current marginal tax brackets in order to reduce your future RMDs and potentially saving tens of thousands, sometimes much more than that, depending on the person, in lifetime taxes. Next, we have RMD aggregation. And if you have multiple IRA accounts out there, you can calculate each RMD separately and then take the total from whichever account makes the most strategic sense. And this matters if you're rebalancing or if one account has better investment options than the other. I am often a fan of just consolidating IRAs in retirement in order to make things more simple and have everything in one place. But if that's not the case, RMD aggregation can be a great strategy. The key here is that you just don't do nothing. The worst thing you can do is ignore this until the deadline, or maybe a year or 2 before the deadline. We've seen people come in having missed an RMD, and the paperwork and penalty relief process is stressful and avoidable. We've also seen people come in 1 year before their RMD and they want to do Roth conversions, but the benefit is a lot more dampened because, well, we only have a year in order to fit in those conversions. Don't wait. Start now. When it comes to RMDs, here's the truth, guys. The RMD rules themselves, they're not that complicated, but the strategy around them, the conversions, the QCDs, the tax bracket management, Social Security interaction, Medicare IRMA surcharges, which we didn't even hit on this video, but we need to in future videos. That's where things get nuanced fast. And this is exactly the kind of planning we do for our clients every single day. We specialize in helping people in and around retirement build income plans that are tax efficient, sustainable, and most importantly, built around their life, not a generic spreadsheet. If you are within 10 years of retirement or already there, I'd love to have a conversation with you. There's a link in the description below to schedule a complimentary intro call with me and our team. No pressure, no sales pitch, just a real conversation about where you are and where you want to be. And if you're not quite ready for that, here's what I'd ask. Please drop a comment below. Tell us, how far are you from your RMD age? What questions do you still have? I read every single comment and I'm so interested to hear what questions that you have out there. Finally, if you found this video helpful, please hit like and subscribe. It genuinely helps other people find this content who need it. Thanks, and we'll see you in the next video.
The content provided is for general information and educational purposes only and should not be considered a recommendation of any particular strategy, investment product, or investing advice of any kind. Content is not intended to be and should not be construed as legal or tax advice and or a legal opinion. Please consult a financial professional for your specific situation. Investing involves risks, including the loss of the entire principal. Past performance does not guarantee future results. The views and opinions expressed here are of the author and do not necessarily reflect the opinion of Strom Private Wealth Management, LLC. Investment advisory services offered through Strom Private Wealth Management, LLC, an SEC-registered investment advisor.